Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's the weekend, so let's recap the action. This wasn't a gentle drift lower. The market cracked into Friday's close. Oil ripped, yields jumped, stocks sold off hard. That's the exact combo that keeps rate cut hopes pinned down. So the setup into the next open day is pretty simple. The tape's bracing for a risk reset, because geopolitics and crude can move first, and gap futures, before cash trading even starts. Sticking with the weekly view, this close mattered as much as the move. The S&P 500 finished at 6,506, down about 1.9% on the week. The Dow and the Nasdaq both dropped about 2.1%. The Russell 2000 fell roughly 1.7%, with a really fragile Friday close. Technically, the message is pretty clear. Sellers controlled the close, and that raises the odds that rallies get sold, until oil and yields finally calm down. Rolling straight from the weekly charts, money flow this week looked like a classic inflation shock rotation. Energy led as crude stayed bid. Defense names and war-sensitive industrials held up, thanks to the geopolitical backdrop. The laggards, exactly what you'd expect with yields rising mega-cap growth and small caps, and the bigger tell is breath damage. When small caps can't hold a bid, it usually caps upside follow-through for the broader market. Into the weekend, the big unresolved tension is still oil volatility. That's why the next open day is a classic gap risk setup. If crude opens Sunday night futures bid again, index futures usually price that as risk off. The second thread is policy expectations. Oil feeding inflation keeps the fewer cuts narrative alive, and then there's crypto trading 24/7. If Bitcoin makes a sharp move before futures reopen, it can shape Monday's risk appetite, especially for high beta tech and AI. The tape's already jittery about supply, but imagine a Trump 2.0 policy that pulls the plug on US oil exports to prioritize domestic prices. The goal might be lower gas at home, but globally you'd get a violent squeeze. As a trader, you'd watch the Brent WTI spread blow out to historic levels. Taking the world's swing producer out of the export market doesn't just raise prices, it breaks the global refining balance. That's a liquidity vacuum, forcing every macro fund to deleverage, fast. An Iranian conflict isn't just an oil story, it's a full-blown commodity shock. Watch the Strait of Hormuz, about 20% of global LNG flows through that choke point. If that gate closes, we're not just talking expensive gas, we're talking industrial shutdowns in Europe and Asia. When energy spikes this fast, it bleeds into everything: aluminum, fertilizer, wheat. For a tape reader, the signal's simple, correlation goes to 1. Everything sells off as investors dash for the only thing that matters: cash and volatility protection. While the world watches the Middle East in horror, the tape in Moscow is telling a different story. Vladimir Putin could end up the ultimate beneficiary. Every dollar move higher in crude pads the Kremlin's war chest, making Western sanctions look like a sieve. If Iranian supply gets throttled, Russian Urals, price cap or not, become the only game in town for desperate refiners. Putin doesn't just get a financial windfall, he picks up geopolitical leverage, using energy as a wedge to chip away at Western resolve on Ukraine. China is the world's largest oil importer, and right now energy is its weak spot. An oil shock hits Beijing's manufacturing engine straight on. Unlike the US, China doesn't have energy independence. You'd see the yuan come under heavy pressure as the import bill explodes, forcing the PBOC into a corner. They want to stimulate, but they can't really fight a global energy spike. For investors, that means the China recovery trade gets stopped out. When the factory of the world catches a cold, everyone feels the fever. So who's the biggest loser here? It's not the billionaires, it's the frontier markets. Countries like Pakistan and Egypt that are already flirting with debt crises. For them, a spike to $120 oil isn't a market correction, it's a sovereign default trigger. As their foreign exchange reserves evaporate just to pay for fuel, social unrest usually follows on the tape. You'll see it first in sovereign bond spreads. The real big loser is global stability, as the gap between the energy haves and energy have-nots turns into a chasm of chaos. Stock watch number 1, XCON, ticker XOM. It mattered this past week because energy acted like the relative strength pocket while the rest of the index de-risked. If crude stays elevated, XOM can keep outperforming, and it also works as a hedge against fresh oil spikes. Heading into the next open day, the XOM red is basically a crude read. M. Next up, NVDA. This is a structural pillar for the Nasdaq. It mattered this week because rising yields tend to compress long-duration growth multiples. NVIDIA is still the market's beta-on-beta name. When traders want risk back on, it usually shows up here first. Heading into the next open day, if NVIDIA can't stabilize even when the macro tape calms down, that's a sign the market still wants to degross. Now Microsoft, ticker MSFT. This past week, megacap tech took the hit as yields climbed, and Microsoft is a key tell for whether big institutions are ready to re-risk. If MSFT can't bounce when the market tries to stabilize, those Nasdaq rallies tend to fail. Heading into the next open day, treat Microsoft as your quality check on any relief bid. For small caps, I'm watching IWM. It mattered this past week because breadth damage showed up there first. Small caps are more rate sensitive and more exposed to tightening conditions. Heading into next week, IWM is your quick read. Are we getting an oversold bounce and stabilizing? Or are conditions tightening again with another leg down? Finally, GBTC as your weekend to Monday bridge. Crypto gives you real-time risk sentiment while equity markets are closed. If Bitcoin sells off hard into Sunday night, that usually tightens risk tolerance for high beta tech at the cash open. Heading into the next open day, GBTC is a clean gap risk proxy. Looking at the calendar, the next U.S. cash session is Monday, March 23rd. On Tuesday, we get Flash Manufacturing PMI at 9:45 a.m. Eastern, along with Flash Services PMI, also Tuesday at 10 a.m. Watch the Richmond Manufacturing Index. Thursday brings unemployment claims at 8:30 a.m. And Friday, we get revised University of Michigan consumer sentiment at 10 a.m. The risk management takeaway: if oil stays the dominant driver, these data prints can amplify moves, but crude headlines may still overrule everything. To wrap it up, this week's close confirmed a defensive market. Macro is firmly in control, oil and yields are still the main levers. Over the weekend, the key is staying flexible. Watch Sunday night futures, watch crude, and use Monday's open to confirm whether we've got real relief or another risk-off reset. Get some rest, come in with a plan, and let the tape prove it first. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.